Welcome back, fellow value investors. In this video, I'm going to be reviewing Zoom, going over their financials, assessing if it's a good investment, and then making a decision whether I should buy more shares of Zoom, hold my shares, or sell my shares in this company. As you likely know, Zoom is the #1 video communications software available. It is very popular and it became really popular during the COVID years. They continue to grow and they issued out their financials recently in the last 2 weeks. So I have a fresh set of financials to take a look at and revalue the company based on my process and my investing criteria. I'd like to share that with you. Before I jump into that, if you can like my video, I'd appreciate it. If you can subscribe to my channel, that'd be great. And please leave comments on Zoom. I will be evaluating Zoom on 3 main criteria. First, it's all about the company. Do I want to be a part owner in the company? Do I like the business? Do I like the industry? And do I think the management team is doing a good job operating the business? Second, the balance sheet. I want a quality balance sheet. I want low debt to be less than 3 times EBITDA. And last, I want a discount on the stock price. I don't buy at a fair price. I don't buy at a premium. I'm a value investor. I like finding companies that have a higher value than their stock price and give me a significant price discount. And based on the answers to those questions, I will buy, hold, or sell Zoom stock. Zoom, I believe, is the easiest to use, best functional video conferencing solution in the marketplace. They have competition from other places. The one that preceded this was WebEx, which is a Cisco product. And for some reason, WebEx has really fallen behind. They used to have a pretty good market share in this space. Of course, there's Microsoft with their solution. And I've used both. And Zoom, I think, is just easier to use. It's also a very popular application. I think the term Zoom is quickly replacing the term video conference. People typically will communicate and say, hey, let's get on a Zoom, or hey, I'm going to schedule a Zoom. So it's becoming pretty much the de facto platform that people meet online and can see one another, can share their screens and really do a lot of work. Their growth is primarily with enterprises. And what that means is big businesses get a license of Zoom so their employees can work remotely, work with their customers remotely. And that's all big cost savings for businesses. If employees do not need to travel, they save a lot of money. So there's a really good proposition for Zoom. I really like the company. I think they are really focused on one area. And we've seen in the software space, other businesses really thrive when they really focus and they become the best at one thing. I'll give you an example, Google search. When Google search came out, it was so darn simple. It was hard to imagine that that business model was going to become so valuable, but it did. And they mastered it. They were better than everybody else. And they took the business away from everybody, including Microsoft. So I think Zoom can continue to just get better and better and better. And being the de facto video conferencing software could give them ability to then grow from that position of strength. I like their management team. I think they continue to stay focused on what they're good at. And I think they're operating the business well. And I like the industry. The other aspect that I like is Zoom has a smaller market cap. I believe just a little over 20 billion. And right now, I believe that small and mid cap stocks are set to rally. And the reason for it is in 2023, small and mid cap stocks did not perform great, but they had very good earnings. They had very good revenue growth. They generated free cash flow. The big mega stocks, the Magnificent Seven stocks, they were the stocks that really took a lot of the gains in 2023. So I believe in 24 that mega cap stocks are going to have a lot of, headwinds to have their stock prices increase, but the small and mid-sized stocks have a lot of room to grow their stock prices toward the value of their companies. So I think that small and mid-cap stocks are the place to be for me in 2024. Looking at their performance, their revenue grew 3%, which is decent. It's not a great, growth rate, but it is good based on the fact that we are in a slow growth economy. I'll take it. The thing that they continue to really focus on is selling to big businesses, because having a customer that maybe has 10,000 licenses of Zoom is far more profitable than selling to 10,000 individual consumers. The processing of all that consumer transactions and so forth is just more expensive. So they are really focusing on that so that they could become more profitable. Good idea. Their churn rate, which is how many customers are they losing, is manageable. So overall, I like their top line revenue. I like that they're focused on selling to big businesses. And I think that big business revenue also is pretty sticky. Businesses will not take away a video conferencing tool from their employees because their employees are just more productive and it's less expensive to have people meet on Zoom versus having to travel to be together or having to travel to be with customers or partners. Looking at the company's profitability, there's some good news there. The company, their gross profit went up 22 basis points, which is 0.2%. And their expenses have been going down. Very good work on the management side and all the employees at Zoom to reduce their expenses. That's very good because it really drove up profit. Very nice rise in profit. They were already a really profitable company and their earnings per share went up 21%. So it's really hitting the bottom line and returning value to shareholders in the form of earnings per share. I use earnings per share as one of the valuation techniques, and I'll be using that a little later. I use free cash flow as the second valuation method, and Zoom has really been growing their cash flow. Great job. So they're becoming more profitable and generating more cash to the point where they have $6.5 billion of cash on the balance sheet. Keep in mind, their market cap's just a little over 20 billion. So they have close to a third of their market cap in the form of cash on the balance sheet. That makes them a very likely takeover target of a bigger company. And I'm just making this up as an example, but let's say Meta or Alphabet or somebody that is a bigger market cap buys Zoom. They'll pay a big premium for the stock. So the stockholders will make out because they'll get a big windfall. And that could happen. Not expecting it. I have no information that leads me to point to facts that tell that specific story, but it's just something that I'm seeing is this company has such a strong balance sheet, has a leading product, and it's a strong takeover target in my book. I believe that Zoom is discounted by 48%. And I get to that discount by looking at the value of the company based on the free cash flows they're going to produce and looking at the earnings per share the company is going to produce, discounting both factors. So I get a net present value of the company based on those factors. Let me go over the free cash flow method first. I'm going to take their current run rate of free cash flow, annualize it, and then grow that cash flow by just 3% over the years 2, 3, and 4. I'll have a terminal value, which is all cash flows after year 4, growing at 3% as well. All those free cash flows, I'm going to discount by 10%. That's a high weighted average cost of capital for Zoom. They have a great balance sheet. They're just a smaller business. So I wanted to go with a larger weighted average cost of capital. That gives me a net present value of all those free cash flows, 25.3 billion. I'm going to add the cash. There's no debt to deduct. They have zero debt on the balance sheet. So it gives me an equity value of the company of 31.8 billion. Now their market cap is 20.7 billion. So it offers up a 57% discount if we look at free cash flows. What that means is I think each share is really worth about $107 per share, but the stock market's selling shares at $68 based on free cash flows. Earnings per share continue to get better. As mentioned, Zoom is doing a good job making themselves, making the expenses go down, making themselves more profitable. And I'm going to take the earnings per share that I expect in the next 4 quarters. This is a conservative number. The company's guiding for a higher number, and that'd be great if they achieve that. It'll just make their stock pop, but I'm going with $4.63 per share. And I'm going to go with a PE of 24. This is a software company. It's growing. It's really profitable. It deserves a 24 PE. Based on that criteria, I'm going to discount the earnings per share that I expect in the company and get to a value of the company of $87.96. Stock's being sold at $68. So if I use the earnings per share method, I get a discount of 29%. I use the free cash flow method, 2/3 of that value, 1/3 of the earnings per share value to get to a blended value and blended discount on Zoom of 48%. Looking at where the stock price is traded for Zoom over the last 12 months, there's been a lot of volatility. Very early in the year, boy, it just shot up. It shot up above $80 per share, which was interesting. But then it really just came down, lost a lot of value. It's had some choppiness. It had that big downturn along with a lot of other stocks. Beginning at the very end of July through the month of October, we saw stocks really go down. but it has seen a rise more recently. I see a significant discount between the current stock price and where I value the company. The company is only up 2.2% for the year to date. Obviously, that's not keeping up with the S&P. And I continue to believe that small and mid cap stocks have been left behind on the rally of 2023. And that just means that this is likely going to be a place where I'm going to see appreciation in a stock because the value of Zoom continues to increase. They generate more free cash flow. The earnings per share continues to improve. The company is growing. The company is the leader from a functional standpoint. Customers prefer Zoom. There's just a lot of good things with this company. So I believe 2024 is going to be a good year for Zoom stock. So should I invest more money in Zoom, just hold, or sell my shares in Zoom? Well, let me go through the three areas and then make a decision. So first, I do like the business. I like software companies, especially software companies that are at top of their game. They're the best ones in the category. The industry is excellent. The company is operated by a very good management team. Debt is zero, so well below 3 times EBITDA. Great discount on the stock. So I'm buying more shares of Zoom. Thank you for watching my video. I appreciate it. Please do me another favor and like my video, subscribe to my channel, and please leave comments on Zoom. I'd love to read what you think of the company. Thanks again for watching.